55 years ago, the world's most powerful currency broke a promise it had kept for nearly 3 decades, and gold has been keeping score ever since. Every single time confidence in the dollar has cracked, gold has answered. Not sometimes, not occasionally, every time. And if you think that pattern ended in the last century, wait until you hear what happened just a few months ago when gold shattered every record in its 5,000-year history. Stay with me, because by the end of this video, you will understand something that most investors never grasp. Gold is not really an investment. It is a report card, and the dollar has been failing that report card again and again for over half a century. Let's go back to the beginning, to a quiet August evening in 1971, when the leader of the free world walked to a podium and announced that the United States would no longer exchange dollars for gold at a fixed rate. For 27 years, under an agreement signed at the end of the Second World War, the dollar had been the anchor of the entire global financial system, and gold had been pegged to that dollar at $35 an ounce. That peg was the backbone of international trade, the reason central banks trusted paper currency at all. And in one televised announcement, that backbone was gone. At the time, the decision was framed as temporary, a pause, a necessary adjustment. It was nothing of the sort. It was the moment the dollar stopped being a claim on something tangible and became, for the first time in modern history, a pure act of faith. And markets do not run on faith alone. They run on confidence, and confidence, once shaken, rarely returns to where it started. Gold noticed immediately. Freed from its artificial ceiling, the metal began a climb that would define an entire decade. By the middle of the 1970s, inflation was eating away at wages across the developed world. Oil shocks tripled the cost of energy overnight. Confidence in paper currency, and especially in the dollar, evaporated. Investors who had spent a generation trusting government-issued money suddenly wanted something a government could not print at will. They wanted gold, and they wanted silver right alongside it. By 1980, gold had rocketed from $35 an ounce to a peak near $850. That is not a typo. A 24-fold increase in less than a decade. Silver moved even more violently, driven partly by aggressive buying that pushed it toward $50 an ounce before a spectacular collapse. That 1980 peak in gold would stand as the all-time record for nearly 3 decades. And for good reason. It represented the purest expression yet of what happens when a currency loses credibility all at once, in full public view, with inflation running in the double digits and a public that no longer believed its money would hold value from one month to the next. But markets swing, and confidence, once restored through aggressive intervention, can suppress gold for a very long time. Through the 1980s and into the 1990s, interest rates were pushed dramatically higher to choke off inflation, and that single policy decision crushed the appeal of gold. Why hold a metal that pays no interest when government bonds are offering returns in the double digits? Gold entered a long, grinding bear market. Central banks, no longer worried about currency collapse, began selling off gold reserves they considered dead weight. One well-publicized sale by a major central bank in the late 90s became almost a symbol of gold's fall from grace. a moment now remembered by market historians as marking the metal's 20-year low. In August of 1999, gold touched around $252 an ounce, a level that seemed to confirm gold's obsolescence in a world of strong currencies, technology stocks, and seemingly endless prosperity. And then the story turned again, because it always does. The early 2000s brought a very different kind of dollar anxiety. This time it wasn't runaway inflation. It was runaway debt, a technology bubble that burst violently, and a series of military conflicts that strained government budgets. The dollar index began a long decline through the middle of the decade. Gold, sensing the shift long before headlines caught up, began a slow, steady climb that would carry it from the low 200s all the way past $1,000 an ounce by 2008. And then came the moment that changed everything for a full generation of investors. A global financial crisis so severe that the entire banking system nearly collapsed. Major financial institutions failed overnight. Credit markets froze. And in response, central banks around the world did something that had never been attempted at that scale before. They created enormous amounts of new currency to prevent total economic collapse, a policy that came to be known as quantitative easing. On paper, it saved the financial system, but it also raised an uncomfortable question that has never fully gone away. If a central bank can conjure trillions of new units of currency out of thin air, what exactly gives that currency its value? Gold answered that question with its price action. From the depths of the financial crisis through 2011, gold surged relentlessly, eventually touching close to $1,900 an ounce. Silver, always the more volatile sibling, moved even faster in percentage terms, briefly approaching $50 an ounce again, a level not seen since that legendary spike 3 decades earlier. What triggered the final leg of that rally wasn't just the money creation itself. It was a moment when a major credit rating agency did something almost unthinkable. It stripped the United States of its top-tier credit rating for the first time in history, citing concerns over long-term fiscal management, and repeated political standoffs over the government's borrowing limit, a downgrade of the world's reserve currency issuer. That is not a small event. That is a crack in the foundation, and gold treated it exactly that way. But once again, the pendulum swung back. As economies slowly stabilized and central banks signaled they would eventually pull back their extraordinary support, gold entered a painful correction. A period that traders now refer to as the taper tantrum saw gold shed enormous value in a short window, falling from its lofty highs down into the $1,200 range by the middle of the decade. Confidence in the dollar, for a time, was restored. Interest rates began rising again. Gold, once more, went quiet but never irrelevant and never forgotten. Then 2020 arrived, and with it a global health crisis unlike anything in living memory. Economies shut down almost overnight. Governments and central banks responded with a scale of monetary and fiscal support that dwarfed even the response to the earlier financial crisis. Interest rates were slashed to near zero. Balance sheets expanded by trillions in a matter of months. And once again, gold did exactly what history had trained it to do. It surged past its old highs, touching just over $2,000 an ounce for the first time ever, as investors around the world sought protection from a currency being created at a pace that had no historical precedent. What followed was one of the most fascinating chapters in this entire story. As the crisis eased and inflation came roaring back with a ferocity not seen in 4 decades, central banks were forced into an aggressive campaign of interest rate hikes to bring prices back under control. Conventional wisdom said this should have crushed gold the same way rate hikes crushed it in the 1980s. And for a while it did put pressure on the metal. The dollar index surged to levels not seen in 20 years. Gold struggled to gain traction even as inflation hit multi-decade highs, a genuinely strange divergence that puzzled many analysts at the time. But underneath the surface, something structural was happening that most retail investors completely missed. Central banks themselves, particularly in large emerging economies, began buying gold at a pace never recorded before, accumulating well over 1,000 tons in a single year. This wasn't speculative trading. This was sovereign nations quietly and deliberately reducing their dependence on dollar-denominated reserves. A slow but unmistakable shift away from decades of dollar dominance in global reserve holdings. Trade tensions, sanctions on major economies, and a growing willingness among nations to settle transactions outside the dollar system all added fuel to this shift. Every time the dollar was used as a geopolitical weapon, more central banks quietly concluded that gold, a neutral asset with no counterparty risk, deserved a bigger seat at the table. By 2024, this accumulation had pushed gold to fresh record highs, and the pace only accelerated into 2025. Tariff disputes reignited concerns about global trade stability. A weakening dollar index throughout the year signaled fading confidence in American economic exceptionalism. Gold rallied more than 60% over the course of the year, a performance not matched since the legendary bull run of the late 1970s. Silver, again playing its historic role as gold's amplified shadow, surged even harder in percentage terms, drawing comparisons to its explosive moves in earlier eras of dollar distrust. And then came 2026, the chapter we are all living through right now. In late January of this year, gold did something it had never done before in its entire history. It surged past $5,500 an ounce in a single trading session, climbing more than $300 in one day alone, eventually touching a record high just shy of $5,600. This wasn't a slow grind. This was a spike driven by a combination of forces converging all at once. Escalating military tension in the Middle East that raised the specter of a wider regional conflict, persistent worries about long-term government borrowing, and a market that had simply run out of patience with fiat currency risk after 5 years of extraordinary money creation and geopolitical instability. Here is the detail that should stop every serious investor in their tracks. When you adjust the legendary 1980 peak of $850 an ounce for inflation, it translates to somewhere around $3,200 in today's money. That means the levels gold reached in early 2026, above $5,000, represent the first time in history that gold has genuinely, meaningfully exceeded its old inflation-adjusted record. This is not a nominal record propped up by decades of currency devaluation. This is a real inflation-adjusted breakout, arguably the most significant technical achievement in the entire history of the gold market. Since that January peak, gold has pulled back, trading through the middle of the year in a range between roughly $4,000 and $4,500 an ounce, as a more hawkish tone from monetary policymakers and periods of dollar strength introduced two-way volatility. As of the most recent trading sessions this summer, gold sits just above $4,000 an ounce, still holding on to gains that would have seemed impossible only 2 years earlier, even as it consolidates below its record highs. The current environment features a central bank holding interest rates steady in the mid-3% range, balancing persistent inflation concerns against a dollar that has shown intermittent strength, all while renewed military strikes in the Middle East keep a geopolitical risk premium firmly embedded in the price of every ounce of gold traded. So what does this entire 55-year journey actually teach us? It teaches us that gold's price has never really been about gold at all. It has always been a mirror held up to the dollar. When the dollar's backing was severed from anything tangible in 1971, gold soared. When double-digit inflation made holding dollars feel like holding melting ice, gold soared again. When a credit downgrade suggested the world's reserve currency issuer could not manage its own finances, gold soared. When a global health crisis triggered the most aggressive money printing in history, gold soared. And when central banks around the world began quietly walking away from dollar dependence altogether, building reserves in gold instead, the metal did not just recover its old highs, it obliterated them in real terms for the first time in nearly half a century. Every single one of these moments shares a common thread. They are all, in one form or another, a crisis of trust. Trust that a currency will hold its purchasing power. Trust that a government will manage its debts responsibly. Trust that a reserve currency will remain neutral rather than weaponized. Trust that a central bank's balance sheet expansion has limits. Each time that trust wavered, capital searched for an alternative, and it kept finding the same one over and over for over 5 decades. An asset nobody can print. An asset with no counterparty. An asset that has functioned as money for longer than any currency in circulation today. What's particularly striking when you study this full timeline is how the recovery periods have grown shorter and the peaks have arrived faster with each passing cycle. It took nearly 9 years to go from the 1971 shock to the 1980 peak. It took decades to eclipse that peak in nominal terms. But the move from the 2020 pandemic high to the 2026 all-time high happened in barely half that time, and the leap from $2,500 to over $5,000 an ounce compressed what once took a full decade into roughly 18 months. Confidence, it seems, is eroding faster with every cycle, and markets are repricing that erosion with increasing speed. Silver, throughout every one of these eras, has told the same story with sharper edges. It moves less during the calm periods and far more violently during the panics, a reflection of its smaller market size and its dual identity as both a monetary metal and an industrial one. When dollar credibility cracks, silver doesn't just follow gold, it tends to outrun it. and then give much of that outperformance back on the way down. That volatility has scared away as many investors as it has rewarded, but for those who understand the pattern, it has repeatedly offered some of the sharpest moves in the entire commodities complex. Where does this leave us heading into the back half of 2026 and beyond? The structural forces that built this current cycle look different from every prior one in one crucial respect. In the past, gold rallies were largely driven by retail investors, by traders, by momentum-chasing headlines. This time, the primary buyer has been sovereign central banks, institutions that do not sell on a bad headline or a single disappointing jobs report. That is a fundamentally different kind of demand, one less prone to the sudden panicked liquidations that ended previous bull markets. It does not mean gold cannot correct further, and it likely will experience sharp pullbacks along the way, exactly as it has after every previous peak in this long history. But it does mean the floor beneath this market may be higher and more durable than in any previous era. The lesson from 1971 to 2026 is not that gold always goes up in a straight line. It emphatically does not. There were 20-year stretches of stagnation, brutal corrections of 30 and 40%, and long periods where gold was written off entirely as a relic with no place in a modern portfolio. The real lesson is narrower and, in many ways, more powerful. Every single time the dollar's credibility has been seriously tested, whether through the collapse of a fixed exchange system, runaway inflation, a sovereign credit downgrade, unprecedented money creation, or a slow-motion shift away from dollar reserves by nations around the world, gold has responded. Not eventually, not with a long lag. It has responded in real time, functioning exactly as it has for thousands of years, as the world's oldest form of insurance against the failures of paper money. Whether the next dollar credibility test comes from renewed geopolitical conflict, a further deterioration in fiscal discipline, or some crisis nobody has even considered yet, history's message across 5.5 decades is remarkably consistent. Watch the dollar's credibility, and you are, in effect, already watching gold's next move before it happens. That is the single most important pattern in this entire history, and it is one worth remembering the next time headlines declare that gold's run has finally gone too far. If this deep dive into more than 50 years of monetary history gave you a clearer picture of how gold really works, consider following along for the next chapter of this story, because if the pattern of the last 5.5 decades tells us anything, it's that this story is far from over.